Hello, this is Makuto. Today we're delving into an intriguing topic. Have you ever wondered why certain colossal corporations, despite their size and influence, opt to keep their affairs private rather than listing on the stock market? It's a question that invites a fascinating journey into the world of business strategy and financial decision-making. Large companies may choose to remain private for a host of reasons. For some, it's about retaining control and avoiding the pressures and scrutiny that come with public trading. For others, it's about flexibility, the ability to make quick decisions without the need to answer to a myriad of shareholders. And then, there are those who simply value their privacy, choosing to keep their financial affairs away from the public eye. But what are these companies and why have they decided to tread this less traveled path? Let's explore some case studies of megacorp that have decided to stay off the stock market. Our first case study is Cargill, an American privately held global food corporation. Cargill, for those who aren't familiar, is a behemoth in the food industry. It's one of the largest privately held corporations in the United States in terms of revenue. Cargill's scope is vast, with operations that span across 70 countries and a workforce that speaks in the hundreds of thousands. But despite its size and influence, Cargill has not sought to list on the stock market. Now you might be wondering, why would such a powerful company choose to stay private? Well, the answer lies in the very nature of its business model. Cargill's decision to stay off the stock market has been a strategic one. It allows the company to make long-term decisions without the pressure of quarterly earnings reports. This means that Cargill can invest in projects that might not yield immediate returns, but that hold potential for substantial growth in the future. For example, think about an innovative food processing technology that could revolutionize the industry but requires years of research and development. A publicly traded company might shy away from such an investment because of the pressure to deliver quick returns to shareholders, but Cargill, in its private status, can afford to take that risk. This long-term view has been a significant factor in Cargill's success. It has allowed the company to weather economic downturns, invest in innovation, and maintain a steady focus on its mission and values. All the while, it has been able to avoid the public scrutiny and short-term financial pressures that often come with being a publicly traded company. So, while the stock market may offer companies access to large amounts of capital, it also comes with its own set of challenges. And for Cargill, the benefits of staying private clearly outweigh the advantages of going public. Cargill's story is a reminder that there is no one-size-fits-all approach to business success. Different strategies work for different companies. And what's most important is finding the path that aligns with a company's unique goals and values. Now let's move on to our next case study. Next up is Koch Industries, one of the largest private companies in America. Koch Industries is a titan in the world of business. With its roots in the oil refining industry, the company has expanded over the years to include a diverse range of sectors. From manufacturing to investments and even to technology, Koch Industries has made its mark on almost every facet of the economy. But what sets Koch Industries apart isn't just its size and influence. It's also the company's steadfast decision to remain privately held. Unlike many of its contemporaries, Koch Industries has chosen to stay off the stock market. This choice is no accident. It's a key part of the company's business strategy. By remaining private, Koch Industries retains control of its operations. It isn't beholden to shareholders, and isn't subject to the often short-term performance pressures that come with being publicly traded. This freedom allows Koch Industries to focus on long-term strategies and investments, fostering a culture of innovation and growth. This decision also grants Koch Industries a degree of privacy that publicly traded companies simply don't have. Without the requirement to disclose financial information to the public, Koch Industries can operate with a level of discretion that many businesses might envy. This privacy can provide a strategic edge, keeping competitors in the dark about the company's plans and performance. But it's not just about secrecy and control. Staying private also allows Koch Industries to maintain its unique corporate culture. Without the demands of shareholders to contend with, the company can prioritize its own values and goals. This autonomy can be a powerful asset, enabling a company to stay true to its vision and values, even in a rapidly changing business landscape. As we've seen, staying private can offer significant advantages for large companies. But what does this mean for you? Understanding why these megacorps are not on the stock market can provide valuable insights for business enthusiasts. The strategies and business models of these private behemoths, Cargill and Koch Industries, can serve as a rich learning resource for smaller businesses. They've demonstrated it's not always necessary to go public to achieve growth and success. Staying private can offer a firm control over its own fate, allowing it to make decisions that best align with its long-term vision rather than being swayed by the short-term demands of shareholders. Let's break it down. Cargill, the largest privately held corporation in the United States by revenue, has managed to retain its family-owned status for over 150 years. By doing so, they have maintained their ability to make strategic decisions quickly and efficiently, without the need for shareholder approval. This has allowed them to pivot and adapt in a rapidly changing market, maintaining their position at the top. Similarly, Koch Industries, another private powerhouse, has shown that staying off the stock market can offer stability and longevity. Their diversified business approach enables them to weather economic ups and downs without the pressure of quarterly earnings reports. They have the freedom to reinvest profits back into the business, fueling innovation and growth. These companies' decisions to stay private have granted them the freedom to focus on long-term strategies and sustainability, rather than being driven by the short-term demands of the stock market. They've been able to maintain a laser focus on their core business and values, which has helped them grow and thrive in a competitive market. In conclusion, while going public can provide a company with the capital needed for expansion, it's not the only path to success. Companies like Cargill and Koch Industries have shown that staying private can offer significant advantages, including greater control, flexibility, and a focus on long-term growth. I'm Mikudo, and I hope you found this discussion enlightening. Until next time, keep delving into the world of business.